Hi, everybody. It's great to be here with you in New York. I want to share with you something I'd be stunned if you're familiar with, and I want to use this as an educational opportunity. And obviously, we're going to talk about diamonds. And I spent many years in hedge funds running strategies, and really focused on macro themes and finding those inflection points where something that was never possible becomes possible, and it's going to dramatically change an asset. And I think what's unique about diamonds is that I'm inviting investors here to invest millions in my company, but you can also just invest $100 in a diamond commodity and allocate to this new asset class. And I'll explain why I think that's a good idea. So first, my background very briefly. I'm a computer nerd, I'm not ashamed to say, from Carnegie Mellon. But starting at university, I started software companies. And I actually started two while I was a student, and they got acquired by Oracle and the Carlyle Group. So that was my career, is coming up with ideas, building software, and starting companies. I've actually now sold 4 companies to private companies in the last 25 years. And it's mostly been doing fintech. And the company that was bought by Carlyle, we built trading systems. And I actually designed about 100 trading systems. And it was because of that trading systems expertise that I became a trader. And I ran the quantitative equities for a trader you may have heard of, Paul Tudor Jones. He's a commodity investor. I ran the quantitative equities. Because of that, I learned from both sides, from the technology, but also as being part of a hedge fund. Ultimately, I brought my team to Millennium. A funny thing happened as I was spending my life building software and trading, is that my wife is a famous jewelry designer named Mimi So. And she taught me all about diamonds. I'm probably the one computer nerd in the world that knows so much about diamonds. But it's because of that I became very interested in this market. Diamonds are a $1.2 trillion natural resource. What I mean by that is the diamonds above ground are worth over $1 trillion. That's more than all of the silver, all of the platinum, all of the palladium, and even rhodium combined. But as you'll see, investors own a little bit of every commodity, every precious metal, up to 30-some% of gold, but generally at least 15% of all these precious metals. But because diamonds are different, that they're no price transparency, there's no liquidity, there's no way to let BlackRock, for example, mark to market their diamonds, they simply couldn't hold them. So the opportunity that I saw, and what I look for are big opportunities, is that what if we could get that 2% to be 10%? That would be $100 billion of diamonds that would have to get shifted from mines or our consumers into the hands of investors. That's the kind of opportunity I like. One thing you'll notice is that whenever a natural resource is financialized, and what I mean by that, it's when it becomes accessible to investors really broadly, that commodity goes up between 300 to 500%. And here we're looking at the price history for gold and silver. Gold was actually declining by 20% from 1990 to 2002. And immediately upon the launch of a gold ETF, gold started a 500% increase. That's because pensions and endowments and sovereign wealth funds, they could buy an ETF. And today, over $200 billion worth of gold is held by ETFs. They drove that price. It happened also with silver, which launched in 2005. That returned 300% in the 7 years after its launch. More recently, we saw this with uranium. It's not a precious metal, unless you have a nuclear plant, it's pretty precious. But uranium was relatively flat for decades, And in 2001, the first uranium ETF launched, and so far, it's only been 2 years, that ETF is up almost 200%. That's driven uranium up 200%. I think you can guess where I'm going, what we're going to be doing with diamonds. The timing is interesting because diamonds right now are essentially at their all-time low. And this has happened periodically since 2000, where diamonds go up, diamonds go down. A lot of people think De Beers controls the diamond prices. Well, they wish they did. They haven't been able to get them to go up for 20 years, and that's how long De Beers has been broken up. But what you'll see here is in 2020 to 2022, you had a significant spike, about 40% price appreciation, but then something temporarily has driven diamond prices down. A lot of people think it's synthetic diamonds, but no, it's actually Russia. Russia produces 33% of all the diamonds, and to fund their invasion of Ukraine, Russia has been dumping diamonds since early 2022, and they really were shut off at the end of 2023. And now you see prices have started to stabilize again. We think they liquidated a very large portion of their stockpile. De Beers, by the way, has no stockpile. The other thing you'll notice is that the diamond prices have generally bounced off of a floor. That's essentially the marginal cost of producing and mining new diamonds. In fact, in November of last year, De Beers canceled all their sales because they weren't economical. So what we've created are the world's first diamond commodities. I have a couple of them in my hand. You can see them at our booth over there. These are diamond standard bars. These have approval to settle CFTC regulated futures and options. We have an agreement to list these on the CME as a futures contract. We also have an options contract listing agreement. We create these commodities under regulatory supervision. It took us years to get multiple regulators to agree that this is fair, transparent, and fungible. But most importantly, they agreed that these two bars are equal. And that's our breakthrough, and it's based on computer science. Our computer system makes sure that every bar has a mix of diamonds that are optimized so that the carat weights, the colors, the clarities, all those complicated things about diamonds, they're the same for every bar. That means they have the same value. And a bar we make today or a bar we make in 25 years, they have the same geology. We don't put a certain dollar value. We have to put the same geology, just like a gold bar. Our system is so reliable that Deloitte was willing to be our auditor, and that they have a very, very high hurdle. So these commodities, they're our monopoly. There's no one else that can make a diamond commodity. We have 8 breakthrough patents on how you make these things. And we think we have it locked up for the next 18 years. This bar is actually a smart commodity. What that means is inside the bar, there's a wireless computer chip. That's also part of our patent. That chip does something very interesting. It knows who owns it. When this bar is at a Brinks vault, which has our wireless technology in it, the bar itself issues a title. That's actually a blockchain token. We have a regulatory license to issue commodity tokens by the Bermuda Monetary Authority. And if I own that title and I sell it to somebody else, they now own that bar. There's actually no fees. Because it's the blockchain, it's very, very cheap in an instant. So that means this bar trades on our spot market 24 hours a day with no fees. If you own this commodity, you buy it today, you can sell it tomorrow. You buy it at the spot price and you sell it at the spot price. There's always going to be some spread, but there's no markup like if you buy jewelry. So these trade on the spot market, but that same token if you deliver it to a futures broker, they can settle a futures contract, or it can be held by an ETF. The interesting application I like is that it can be used for digital assets, which I'll explain in a second. Our company makes a profit by buying diamonds basically as a market maker and then selling them as a finished commodity. That's a spread. We don't actually control that spread. It goes up and it goes down. But suffice to say, it's been profitable. And our goal is to support all the different types of products for diamonds that you have for gold, futures, ETFs, and funds. And there's a lot of new applications for diamonds, which were surprising. The biggest one is for Islamic finance. I didn't expect that, but I've been to Saudi Arabia now 3 times, and we have several banks that have agreed to use our commodity for what's called murabaha, which is where in the Muslim world, you're not allowed to lend money and charge interest. You have to lend a commodity that the borrower sells at the market, and that's how they get the funding. So that's one of the interesting applications. The other application is digital currency, which I'll come back to. This is the inside information that I'm going to share with you, and it's legal because it's a commodity inside information. It's not about a stock tip. We've already listed a private fund in the United States, but we also have approval for an ETF. That's going to be coming out in this year. That ETF already has anchor investors and it already has underwriters. It's completed testing the waters. That ETF is going to be coming out. Now, I'm not telling you to participate in the ETF. What I'm saying is you can build a position in diamonds now that's going to be impacted by the demand created by that ETF. Not just the ETF, but the futures, the options, the digital assets, the Islamic finance. What I'm telling you is that diamonds are changing. They're useful in ways that no other assets can be used to asset-backed financial applications. The most interesting one, perhaps, is carats. This commodity, when it's in a vault, if you push a button because you own it, it will issue a currency called carats. This is why we call the company Diamond Standard. It's going back to the gold standard, where you used to be able to give the money back to the government and they would give you gold. In this case, you give the carats back and Brinks gives you diamonds, a diamond commodity. What's special about carats is that they're legally unique. They're not a virtual currency and they're not a security. They're legally a commodity. And that means they're not subject to all of the money transmitter regulations. We still do anti-money laundering, but you don't need 48 repetitive licenses just in the United States. That saves a lot of money for all the platforms. So what we're raising right now is $25 million in our company. We've already filled 16 million of that in the last few weeks, so there's 9 million available. Just in the last week, we have an exciting new investor. His name is Mark Cutifani. He was the chairman and CEO of Anglo American for 12 years. He was also the chairman of De Beers. We have a lot of very well-known investors based on my years and years in the hedge fund business. So we invite you to consider, if you're the type of family office that likes fintech, venture types of investments, please contact me. You can visit our website at diamondstandard.co, or you can email me at hello@diamondstandard.co. But if you're not interested in venture, I suggest you take a look and learn more about the Diamond Standard commodities. Because as I've mentioned, all of these factors, the supply is diminishing, the demand for diamonds is rising, we are launching all of these financial products. That's going to drive diamond prices up. People ask about synthetic diamonds. They've fallen through the floor. And what I predict is diamond retailers are going to stop selling synthetic diamonds because they may make 1,000% markup, but they can't make the revenue. So that's it. Please visit diamondstandard.co if you'd like to learn more. There's a huge amount of press in the Wall Street Journal, et cetera. Thank you, everybody.